The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. Fragile ceasefire. Iran accuses the US of violating the agreement, and Israel continues its assault on Lebanon. Vice President JD Vance set to lead peace efforts in Pakistan this weekend. Now, he says some tensions are bound to continue.
No ceasefire ever goes without a little bit of choppiness. What we have been very clear about is that we want to stop the bombing. We want our allies to stop the bombing, and we want the Iranians to do the same thing.
Fading ceasefire optimism stalling the global stock market rally as oil prices rebound. Asian equities moving lower and futures pointing to a mildly negative open here in Europe.
The NATO Secretary-General Mark Rutte faces up to a frustrated President Trump after member states refused to back the US military campaign against Iran. Rutte saying talks were frank, but still between two good friends.
A warm welcome to Squawk Box. Well, look, I don't think it's a great surprise to anybody who's studied any history or any end of conflict or any hope for end of conflict that the truce we're seeing at the moment is being challenged by parties on both sides. That is not an outlandish theorem. But the temporary truce between the US and Iran appears fragile, with a large gap emerging between their respective interpretations of the ceasefire since its announcement just over 24 hours ago. Iran's parliament speaker on Wednesday accused Washington of 3 violations, saying peace talks would be, quote, unreasonable amid the breaches, which included continued Israeli strikes on Lebanon. Well, earlier this morning, the US president, for his part, Donald Trump, said Washington's military assets will remain in place around Iran until the, quote, real agreement reached is fully complied with. The US leader also warned that the US military campaign will resume if a deal is not reached. Attention now turning to peace talks in Islamabad this weekend, with the White House confirming the Vice President JD Vance will lead the US delegation. And for those of you who are watching the mood music in the administration, you'll know that JD Vance has perhaps had a more ambiguous position in some people's eyes, because he is one of those America First advocates who doesn't appear to be as in favor of this conflict as others within the administration. So interesting that Vance is leading those negotiations. Well, the top White House officials weighed in on the state of the temporary truce.
Ceasefires are always messy. An hour after the president announced the ceasefire, the Iranians launched a bunch of missiles. Then the Israelis responded. Then some of the Gulf Arab states responded. This is the nature of a ceasefire. No ceasefire ever goes without a little bit of choppiness. What we have been very clear about is that we want to stop the bombing. We want our allies to stop the bombing, and we want the Iranians to do the same thing. We're seeing evidence that things are going in the right direction, but it's going to take a little time.
The president's red lines, namely the end of Iranian enrichment in Iran, have not changed. And the idea that President Trump would ever accept an Iranian wish list as a deal is completely absurd. The president will only make a deal that serves in the best interests of the United States of America, and he as a negotiating team will focus on this effort over the next 2 weeks.
Let's get to Dan. Dan, as I just said, these early stages of any ceasefire, any truce, any agreement, any end of conflict is always messy. But what's the feeling on the ground in the UAE about how long this could last, and actually whether something meaningful is happening on the peace front?
Well, Steve, the ceasefire is fragile at best, and as you reported, Israel launched its heaviest wave of airstrikes on Lebanon since the war began overnight. Actually, Lebanon Civil Defense says at least 250 people have been killed, and the images coming out of Beirut are really stark, and they're of course now driving the diplomatic conversation this morning as well. Remember though, Israel was not a party to these ceasefire negotiations. The deal was brokered between Washington and Tehran, with Pakistan serving as mediator. Prime Minister Netanyahu subsequently made clear that as far as Israel is concerned, the deal only applies to direct US-Iran hostilities, and also said that Lebanon is a separate war in his view. And that position was never really reconciled with Pakistan's Prime Minister, who announced the deal and said it covered all fronts, including Lebanon. So Iran is calling Israel's strikes on Lebanon a direct violation of the ceasefire framework. And the IRGC also briefly closed the Strait of Hormuz again in response, actually issuing a map of alternative routes and warning of naval mines in the main channel as well. Of course, we've seen asset markets react to this. Oil, which had dipped below $95 a barrel on hopes of a lasting truce, has been bid back up through the course of the Asia session. We're also seeing equity markets that had rallied sharply on that initial announcement. Those gains are now tapering as well. President Trump also out with a fresh Truth Social post only in the last few hours, now saying that all US ships, aircraft, and military personnel will remain in place around Iran until the real agreement on a ceasefire is fully complied with, warning of more conflict otherwise. The US is also now threatening 50% tariffs on any nation that supplies Iran with weapons during this 2-week window. So of course, all eyes today are on exactly what happens inside Lebanon, whether or not we will see Iranian responses as well. And of course, these peace talks remain scheduled for Saturday in Islamabad. We're seeing reports that the Pakistani delegation is on its way to that meeting already. Of course, that is now reportedly being led by Vice President JD Vance as well, and Iranian Parliamentary Speaker Mohammad Khalibaf. So the Iranian delegation heading to Pakistan in anticipation of that meeting with the Americans. But of course, whether those talks actually happen at all now, of course, hinges on a ceasefire that this morning appears to be hanging by a thread. It's back over to you.
Thank you very much indeed for that, Dan. Right, let's take a look at these US markets and the rest of the markets around the world.
Yeah, strong performance on Wall Street in the session yesterday. In the Wednesday regular session, the Dow Jones closing up 2.85%. The S&P also advancing, and the Nasdaq adding 2.8% yesterday. A lot of that risk-on sentiment fueled by some optimism around the talks that there would be this 2-week ceasefire between the US and Iran, and the talks would take place, brokered by Pakistan at the weekend, as Dan was just mentioning. There were also a release of Fed minutes from the March meeting suggesting that most Fed officials still expect to cut rates this year. Again, that adding to some of the positive sentiment we were seeing on the US markets. Within half a day, things had changed, and that was evident in the Asian markets. The ceasefire looking fragile, some perhaps questioning whether the 2-week ceasefire would see out 2 days, and you can see the jitters around that being reflected in the benchmarks across the Asia-Pacific region. The Kospi, South Korean benchmark, leading the losses, down 1.75%. The other main benchmarks also giving up ground in the Thursday session. Let's see how that's likely to filter through to the European markets, and a mixed open being called, according to the futures, indicating to a stronger open on the FTSE. Of course, the higher oil price, we've seen oil rise, is still below $100 a barrel for both Brent and US light crude, but oil advancing about 2.5%, 2.4% thereabouts, and hovering around $97 a barrel. Of course, the FTSE 100, with its oil majors benefiting to an extent from that, but its peers looking to give up some ground, potentially when the session gets underway in about an hour from now, just under an hour from now. In terms of what's ahead on Wall Street, US futures point to a negative open as well. Some data out in the US later, the personal consumption expenditure price index, Fed's preferred measure of inflation, and also the weekly jobless claims, easy for you to say, are due out to, and that will be watched, of course, closely by the markets. Steve?
Ben Guttridge, Market Insights, Strategist Investor. How long have you been around in the markets? I can't remember.
25 years. I started when I was 10.
Is it 25 years?
It's that 25
so
years.
So a quarter of a century, and you, so which gives you eminent knowledge of how these things can be overplayed and can be underplayed as well. And as far as I'm concerned, unfortunately, I've been around markets even longer than that, and I too started when I was 10. But it's very binary, war on, war off in many ways, and then it seems to be the market yesterday off to the races on hopes that war end. But the problem is, the longer we get this interregnum, this uncertain stage where there is still violence going on both sides and the ramifications are building up, then it has a longer term effect on that risk on scenario, i.e. where everyone just gets back to normal. And the problem is, the more this goes on, the more effects it has on the rest of all your scenarios and things you come to talk about on a regular basis.
Well, does it, Steve? Let's have a bit of a debate on that.
Yeah.
You know, I mean, I would suggest there is still lots of humanitarian issues to sort of deal with and wrestle with and be concerned with, and the idea we can get sort of smooth and an imminent sort of end to kinetic action seems unlikely. But what the market wants to see, the sort of cold and calculating sphere of the markets, is that Straits of Hormuz, like reopening, becoming much more porous. You know, you look to the sort of Russia-Ukraine challenges still ongoing, but the market has moved on from that. You know, and I think you could see something of a similar kind in the Middle East, that of, or we would hope, a dramatic reduction in sort of kinetic action. But, you know, as I say, a likelihood or certainly potential of ongoing action. But if the Straits of Hormuz are reopened, the markets could potentially deal with that.
We have to play scenarios here because no one knows what's going to happen out of Tehran or what's going to happen out of Truth Social next. So let's just play scenarios that the truce holds. That's a big if, but let's go with it. What happens then to your investment decision making?
Well, you would expect in I feel like I'm walking into a trap here, but I thought that would be like a really powerful sort of risk-on move. You know, that of course we know that the tankers that come out of the Straits of Hormuz, you know, that offers some temporary respite, and there'll be some back and forth about, you know, how secure is this deal, how much are insurance costs, you know, the idea that the economies are going to want to replenish reserves, perhaps to a higher level than before. That could all keep commodity prices sort of quite well bid. But I think the stock market, and certainly, I guess, longer dated bonds, would envision something of a return to normalcy and could look through those challenges. But commodity prices could remain well bid, even in a great truth scenario.
You certainly weren't walking into a trap. But my problem here is all the interest rate assumptions and all the valuation assumptions that were in place before the war have now just nudged up a little bit in terms of the interest rates up and valuations down a little bit, because I think there will be lasting ramifications of this and all the other actions that have unsettled the world over the last 12 months or so. My problem is, looking at the FOMC last night, is that they by and large, apart from one member who appears to know that rates should go low, by and large they just seem to be in the fog like the rest of us, the fog of war, so to speak, as well. So the chances of the market getting what it wants on rates, which is so important at the moment for the fixed income market, for the sovereign, for the private credit markets, and indeed for the equity markets and the technology trade, the chance of the market getting what it wants now are less than they were beforehand. So whilst I think you're right. I think the market does try to go off to the races. But what I'm saying is the fundamentals look sketchier than they were before the war.
Well, there were sort of calls for 4, then cuts to expectations for 2 or 1, and I still think potentially 0. I'm not talking about Arsenal silverware. I'm talking about Bank of England rate hikes. Look, I think the market is sort of anticipating still sort of 1 or 2 hikes there. So I think that could still be priced, could be taken out.
Yeah.
You know, I think like the UK economy specifically has some labour market challenges. And, you know, it would be very cruel to be putting up interest rates in an environment where there is sort of a consumer sort of price sort of squeeze, spending squeeze. And I think that's sort of similar in Europe as well. I think the starting position from the Federal Reserve was different. There was expectations for far more cuts. And, of course, there is some motivation from new appointments in that lobby, in that group, to move more dramatically on rate cuts. So that I still think the market can take courage from removing any interest rate hikes from the Bank of England and the ECB and only getting like 1 out of the Federal Reserve. It's not the magnitude that we were expecting at the start of the year, but it's a better outcome than where we were a few weeks ago. But look, I think like another issue here is that like inflationary challenges are going to remain more potent, more frequent than they have been in the past. So, you know, the idea that central banks can cut aggressively on interest rates into the future, you know, I think it has limitations, and so we need to diversify portfolios a bit better than just bonds.
Ben, the comments of one of our guests about 24 hours ago ringing in my ears when she said the market's euphoric relief and the knee-jerk sell-off of oil look overdone and premature. That 15% drop, was that on the kind of magnitude that you expected, or do you think it was overdone?
Well, I mean, it's hard to put a specific value on spot price of oil today, given the fog of war that we talk about and the uncertainty. But I think dramatic relief in the oil price made a lot of sense. I think there is a very motivated US administration here to try and get something resolved for the economy and, of course, for their approval ratings with the midterms looming. But, of course, we would expect some back and forth on oil prices because ceasefires are very difficult to hold, negotiations are very difficult to have, and there are certainly some contentious issues that seem difficult to iron out. But I think this US administration, given its motivations, may be a little bit more pragmatic in these conversations than we might have thought a few weeks ago. So no, I think I think a dramatically lower oil price makes sense. The magnitude, we can argue a few dollars here or there and expect volatility, but no, I think the peak fear is likely behind us, and so oil price coming lower makes a lot of sense.
And then in terms of assessing kind of how...
one of my Invesco colleagues who said the oil price was...
No, it was from Vanda Insights. The founder was speaking to us from New Delhi, and it just really struck with me. She said that she felt that the markets had mispriced the truce, and there was this over-enthusiasm and over-optimism. It's the way that she saw it. But I suppose tied to that, the peace talks that I suppose anyone watching this and trying to figure out where things might go, what the landscape may look like after that, there are so many different versions of Iran's 10-point plan that it must be very tricky to know. What is the landscape going to look like? Is there going to be a 1 million toll booth charge on the Strait of Hormuz? What does that mean for oil prices, inflation, and markets more generally? I mean, the fog almost seems to be getting denser rather than lifting.
Can I make before Ben comes in, can I make a conspiracy theory here? Bear in mind, I kind of don't necessarily... No, hang on a second.
Go on.
The US doesn't get its oil from the Straits of Hormuz. Chinese get their oil from the Straits of Hormuz. The Indians get their oil from the Strait of Hormuz. So Asia gets it. A lot of other people get their oil from the Strait of Hormuz. Making the comparative cost of product more expensive out of the Middle East compared to the product that comes out of North America is actually an interesting competitive economic position for the United States. I'm just going to chuck that one out there.
Short term, but if they're thinking longer term, what if that toll is priced in yuan, for example, and that then starts to have an impact on the dollar's
I hear you. That's a
status.
de-dollarization story, but that's a separate point to the fact that actually a competitive advantage for US product compared to Middle Eastern product from the end of this as well wouldn't necessarily be against American interests.
I'll leave up to you, Ben, whether to comment on Steve's theory.
Fascinating to watch, guys. I appreciate this.
That's what Scorebox does. We just chuck it around.
Look, I mean, I actually sort of think in relation to the toll, it does seem like a situation that would be untenable for a long period for the US administration, but I don't think it moves the needle dramatically on the price of oil. And to your point, the idea that we could make bold forecasts on how this is all going to sort of settle and the arrangements that would be in place, it would be very bold to make such calls. I think what we can be relatively confident about is that commodities, oil prices are going to command some sort of geopolitical risk premium for a little while. Yes, we think they can come off highs, but can stay elevated. And I think businesses that are sort of tied into the commodity complex and that can support spheres of influence and supply chains, like energy businesses, miners, FTSE 100 can do that. Sorry, Steve.
No, don't apologise. Don't apologise for me interrupting you. But I like that though.
Don't set that as a precedent, goodness.
No, I like that. I like guests apologising when I interrupt them. That's really good. Ben, just final. If we do get an elongation of the truce, what's the first trade you're looking to put on?
Well, it would probably have to be Asia, I think. Okay. The market that's been the most punished, given the heavy imports of oil and energy. And the impact that's had, that would be where the relief trade extends. There's lots of other things to be positive about in relation to emerging markets and Asian assets, so I would be comfortable allocating capital there.
Nice to see you, Ben.
And
Thanks for your time as ever. Ben Gutteridge, Market Insight Strategist at Invesco.
Still to come on the show, the US President, Donald Trump, again hits out at NATO hours after meeting its Secretary General. Plus, Fed minutes show officials still expect rate cuts ahead this year despite headwinds from the conflict in the Middle East. And we'll be talking all things defence with the former commandant of the RAF's Air and Space Warfare Centre, Blythe Crawford. That conversation's at 9:30 London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts. Welcome back. Countries across the globe are looking to respond to the energy price shock triggered by the war in Iran. We are tracking the impacts across Asia today. We've got a really great graphic representation. I'm delighted, actually, that we've got Elaine in Hong Kong at a fuel station. But I was watching both of you earlier on because, of course, Carrie and Joji also joins us. And Carrie, I was loving the visual representation of how this is affecting Japan earlier on this morning. Explain more.
Yeah, well, good morning. I'm here at Tsukiji Fish Market, and of course, this is Seafood Central, and you can really see how the impact of this war is playing out in the fisheries industry and the way Japan eats. So, first of all, the rising cost of fuel means fewer ships are going out to sea, and that's a problem, and it's affecting the overall catch here at the Tsukiji Fish Market. Now, it's most acute for things like tuna. So this is toro, which is basically tuna. I mean, this is filet, but the actual fish is really ginormous, right? So that involves deep sea fishing. And for that, to do that, you have to go way further out, maybe close to India. And the fuel costs for that, they say, are now about 3 times higher than they were at the start of the war. The other thing, I mean, we talk about the supply chain bottlenecks, but let's talk way, way downstream, because we talk about crude a lot, but Japan actually has a huge, vast number of crude reserves, which it has been releasing from its stockpile, but it has far less in terms of naphtha. And the government has taken great measures to explain over the last couple of weeks to tell people, no, it's going to be okay. We have enough. They're saying we have 4 months, which is not a whole lot. So crude is refined into naphtha, which you need to make stuff like ethylene, which goes into everything from plastic, which Mr. Saito here, the owner, is using right now. And especially ethylene is used for stuff like this. So this is styrofoam, right? And you need a lot of this to keep the fish fresh. And he's been telling me that the price of styrofoam in these cases has been going up since the start of the war. So that's something that's happening really way downstream in the supply chain. So let's talk about other things as well. And just to show you how acute this is for Japan, one of my favorite fish, I think they're sold out now, it's the end of the day, is amberjack. And amberjack is actually farm raised, so that means it's in aquacultures. But the amberjack, the baby amberjack, actually most of it comes from China. And there are fewer ships coming from China because of the fuel costs. And listen to this. Baby amberjack, if it's a small between 10 centimeters and 30 centimeters, you can import it without paying tariffs. But if they get any bigger than that, the tariff goes up to 10%. So they want to avoid that. But with the fewer ships coming in, meanwhile, the baby amberjack is getting bigger and bigger. So the Japanese government recently announced a special provision as a result of this war that for the time being, baby amberjack up to 50 centimeters can come in without tariffs. So that goes to show you how much of an impact this is having on the fisheries industry. And of course, the way we eat. I mean, I'm also saying that because the catch is a lot less than it would be normally at this time, usually around this time, you'd see a lot of what they call white bait, which is the baby sardines, really tiny, glassy. You're seeing far less of that throughout the market today. I've been here all morning. So it's really impacting the way we eat because generally, it's a foodie heaven here in Japan. We like to eat with the seasons. So that's one impact as well. And I think here overall in Takeshi, it's very popular among the tourists, right? So right now they're saying there hasn't been a lot of drop off, but they are concerned if the travel costs start to go up, if that impacts tourism. People like Mr. Sato here are concerned because it's not just a shopping market for the locals here like us who shop here, but it's a big magnet for the tourists as well. So this is how literally the food chain has been disrupted as a result of this war. See?
Carrie, there is nothing about that package that I didn't love. Thank you very much indeed, and thanks Sato-san as well for working so assiduously behind your amazing description. In fact, you had me doing many things, including searching on a well-known search engine, Amberjack, and indeed styrofoam. And of course, as you graphically illustrated, styrofoam is composed mainly of polystyrene, which is a type of plastic derived from, you guessed it, petroleum. Thank you very much indeed for that. Elaine. Well, there's a lot to live up to after that package. I'm sure you'll rise to the challenge as well, because I was watching your earlier package and it is amazing the costs that are having to be absorbed by drivers.
That's right, and here I'm in Hong Kong, some of the most expensive places on earth to buy gasoline. So this is not your average gas station here, and since the start of the war, prices have only increased. Premium petrol prices climbed 25% on average in these weeks, and diesel prices have jumped 22%, consistent across Hong Kong's 5 major providers. Now, at this Caltex gas station, you'll see in the sign behind me, diesel prices now at the equivalent of $4.5 per liter, even slightly higher than premium petrol prices, despite diesel being exempt from fuel duties. Now, there are many electric vehicles in Hong Kong's streets, and EV owners are not immune from higher fuel and electricity costs. But it's really diesel and petrol drivers that are bearing a heavier burden now. We've seen Hong Kong car owners drive across the border to mainland China to refuel because of cheaper prices there. But for now, we're seeing minibus drivers, food delivery workers, bus operators being the ones who are absorbing these higher costs now. Often you'll see food delivery workers and also self-employed minibus drivers having to pay out of their own pocket during their shifts on these higher fuel prices. And some bus operators have tried to reduce service as well, but authorities said they need to provide warning in advance. Now, industry representatives have called for measures like temporary subsidies to help cushion the blow. And we've seen the stock market, of course, cheering the ceasefire, but the real economy, including workers on the ground and businesses, are still feeling the weight of this energy shock, and relief could be some time away for this highly expensive and import-dependent city until global energy productions and shipments stabilize.